Ticker symbol NU has had a stellar year, rising over 100%, and today we'll be looking at a clear market leader which has a very wide moat. This company obviously has explosive growth, with over 62% year-over-year revenue growth, very solid fundamentals, and rising efficiency ratios. So today we'll be looking at NU Holdings, a financial technology company. In their annual report, they say that their mission is to revolutionize financial services for Latin American consumers and small businesses, challenging the status quo of incumbent banks. They're basically a financial super app. If you've heard of SoFi or Revolut, this is basically the equivalent, but in Latin America. It's grown so big it has over 100 million users in only 3 countries in Latin America, which are Brazil, Mexico, and Colombia. They have the money platform. This basically supports users in all their activities, whether it's spending, saving, investing, protecting, or even borrowing money. In fact, they've grown so big that in 2023, Nubank ranked 4th in Brazil among financial institutions. Now we can break their strategy into 3 different pillars. The first one being that they want to continue to grow their base of loyal customers and enhance cross-selling and upselling opportunities. One of the main ways in which they've managed to grow to such a large number of customers is through member-get-member programs, and this has been working extremely well. So they want to keep doing this until they've saturated the Latin American market. Of course, they want to develop and launch new products and features and execute strategic acquisitions in order to accelerate this process. They have a very solid track record of developing and launching successfully new features inside their super app. Number 3 is that they want to continue expanding in their current markets, Brazil, Mexico, and Colombia, and they want to expand into new geographies. I read that they have more than 100 million users. However, the combined addressable market for Brazil, Mexico, and Colombia is around 650 million people, so they still have room to run. When we look at their financial analysis, it looks really solid. Their return on capital employed is only 6%, but this is because the company turned profitable very recently. Because of that, their net income is pretty small, which makes the return on capital employed be smaller than expected. Now their interest coverage ratio is amazing, 100 times. They basically have very little interest to repay, so they have no need to worry about that anytime soon. And then they have a very solid cash conversion of 99%. Since they have barely any capex, all of their cash from operations is converted into free cash flow. Now their profit margin is 45% and their operating margin is currently low at 15%, but through the implementation of new features and when they're done adding new customers, they will for sure be able to increase this just based on their scale. And I told you this company has explosive growth. Their revenue has soared by 62% year over year, and it shows no traces of actually slowing down. The most interesting part about this is the trajectory of their net margin. You can see that it has increased every single quarter since December 2022. This, of course, has made their net income and their gross profit to increase by a lot more than the revenue in the same time period, which is something that us investors love to see. And obviously, when we're looking at their efficiency ratios, these are also rising. The return on invested capital, which is the one we mainly focus on from this slide, is just at around 6-7%, but it has been consistently increasing, and we hope to see it soon in that 15% range we like to see it in. And now looking at their leverage, we can see that this company has consistently been growing their total assets and total liabilities. However, the difference between these has stayed pretty consistent since 2021. They're maintaining their total assets to be above their total liabilities, which I believe is a pretty smart move. And then of course, they're growing their equity to be larger than their debt. This will allow them to keep a low debt to equity ratio and attract more investors. But now we'll dive into the fundamental analysis, where this company gets a very solid 6 out of 8. They of course have very low liability risk since their interest coverage ratio is pretty high, and this allows them to be a relatively safe investment. Of course, we do have to consider that it's in the financial industry, so they may be hiding their leverage in other places in their balance sheet. However, from what I have seen, they do have a solid balance sheet and they look fine. Now, this company is able to grow their cash flows organically, and the main reason why this is happening is because they're able to grow their revenues organically. And now the most important part of this slide is always pricing power and the competitive advantage or existing moat, and this company has both. They've been able to outgrow and steal the market share from all the other established banks in Brazil, Mexico, and Colombia because their offering is super differentiated. First of all, it's a digital native platform, which means that it's more comfortable and a lot easier to use than all the other banks, which are normally heavy on administrative tasks. One thing that this company has done is that since they have no physical offices and they have very low headcount comparison to the other banks, they've been able to reduce the fees. And we have to consider that Brazil was one of the countries with the highest amount of banking fees of the whole world. So by new holdings actually coming in and reducing this by a lot, they've managed to attract a lot of customers, which of course is their competitive advantage since other companies are not able to reduce their fees at such an extent. However, I do believe that they have pricing power because they're attracting all these customers mainly for their savings plan. And although they have a lot less fees, they're able to raise them whenever they want. Since their offering is such well differentiated from anything else that exists in these markets, customers will not have any other platform that allows them to save, invest, borrow, protect their money, or even earn it inside the same platform, which will make them be able to pay more for this service than for any other bank. However, 2 points that I did not like is first of all that their cash flows are not consistent if we look at them from quarter to quarter. They have a lot of one-off items, which I'm not a big fan of. And now the second thing I didn't like is the dividends and their share buybacks. They currently do not pay a dividend, which I'm okay with since they're growing at a very fast pace. They want to reinvest everything that they make back into the business. And the second point, I don't mind that they don't do share buybacks. The one thing that I don't like these companies doing, however, is issuing new shares, because what I have seen is that this company's shares outstanding have actually been increasing in the past. Now, in terms of valuation, it's not often to find a company that is growing at a 60% rate, trading at a 41 times PE earnings ratio. Now, we can see that their price to cash flow ratio is only 5 times, but this is of course because of their one-off items I was mentioning. And now their free cash flow yield is at 2.23%, which is lower than the long-term inflation rate of 3%. This makes me think that the company is not trading at an attractive valuation yet. And we have to remember that this free cash flow includes one-off items. If you remove those one-off items, this free cash flow yield is probably even lower. But now the risk impossible challenges I mainly see is first of all the competitor landscape. I think that they're currently the best offering in the Latin American market. However, their offering is not unique. You have SoFi and Revolut, which are bigger businesses, and they're working in markets which have a higher average revenue per user. When these companies are done expanding in their markets, I do believe that they'll enter Latin America, and this will be a problem for Nu. However, there's a long time till that happens. I wouldn't be worried about that. Not meeting performance objectives, I put this at a 70%. The biggest problem for me here is that they've grown through a strategy which is not sustainable, which is member get member. This is a great way to increase the number of users that you have, but I'm not sure that this correctly translates into active users. Of course, at the current moment, they have actually been able to grow their active users by that, but I'm not sure this is a sustainable long-term strategy. Additionally, they've already grown so big in some markets, such as Brazil, that I believe their growth rates will have to slow down at any point in the future. And when such a hyped growth stock such as this company, when the growth actually starts to slow down, stock prices usually suffer big time. Now, before we move on, please remember I'm not a financial advisor and this is not financial advice, so please do your own due diligence. However, I believe that this company has a strong competitive advantage, but it does not currently provide consistent cash flows and it does not currently have a high return on capital employed. So I do believe that this is a good company and it's a great growth investment if you can buy it at a better valuation. So thank you for watching. As always, this has been the Cash Flow Compounder. Join the free Patreon for extra content and there is a link in bio for a free stock if you join Trade Republic.